Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings before they make us senseless. Today we're diving into Lennar Corporation's latest quarterly report, and trust me, with all those numbers and legal jargon, it can feel like you're building a house without instructions. Lennar, one of the nation's largest home builders, just released their Form 10Q for the period ending February 28, 2025. In short, expect talk of spin-offs, rising costs, and a market that's, well, let's just say it's not exactly booming. This report covers Lennar's performance for the first quarter of 2025. This is a snapshot of how the company performed during those 3 months, from December to February. This is a follow-up to their annual report, which covers the entire year. Lennar has two classes of common stock, Class A trading under the symbol EN and Class B under Lang B, both listed on the New York Stock Exchange. Alright, let's get to the heart of the matter, the financial statements. This is where we see how the company actually performed. First up, the balance sheet, which is a snapshot of what the company owns and owes. Looking at their assets, the biggest number that stand out is the cash and cash equivalents. Home building cash and cash equivalents came in at $2.3 billion, a significant drop from the $4.7 billion they had back in November. Basically, they used a lot of their cash reserves. Another thing to point out is the inventory. Lennar splits it between what it owns and what it consolidated inventory not owned. The consolidated inventory not owned is at $355 billion. These aren't properties that Lennar directly owns, but they control through various agreements, mainly land under purchase options. This allows them to operate without tying up as much capital. It's like leasing instead of buying. This $3.5 billion number is held with $3 billion in liabilities. Now, the income statement shows how profitable they were over the last 3 months. The main revenue driver was again home building, bringing in $7.3 billion, a jump from last year's $6.9 billion. Overall, Lennar's total revenue is $7.6 billion. However, the money they spent to make that money also increased. Total costs and expenses reached $6.9 billion. And when you take into account a few gains and losses, you are left with $698 million in earnings before income taxes. Last year was $930 million. That's about a 25% drop. After taxes, the net earnings attributable to Lennar come in at $519.5 million, or $2.19 per share, falling from last year's $71.30 tran dollars or $19.30 per share, falling from last year's 71 share. Finally, the statement of cash flows tells us how cash moved in and out of the company. This is super important. Lennar used $289 million in operating activities this quarter, compared to making $368 million last year. This means that Lennar spent more cash than it made, and you can see a few things impacted the statement of cash flows. They put $758 million into deposits and pre-acquisition costs on real estate. Basically, they are investing in future land deals, securing options to buy land later. This costs money now, but hopefully pays off later. Also, they were to $15 million decrease in accounts payable and other liabilities, which might be because they paid back some of the loans. On the plus side, they got about $233 million from the sale of investments. This helps offset the cash outflow from operations. Net cash used in financing activities at $2.1 billion. They are using the large chunk of the money for net repayments under warehouse facilities and repurchasing stocks. All told, cash and cash equivalents decreased by $2.4 a substantial amount. This explains why I mentioned the drop in cash earlier. This was their activity for the quarter and the reason to the drop. Lennar divides its operations into several segments, with home building being the biggest. There's also financial services, which does mortgages and title work, then multifamily that builds apartments, and Lennar Other, a catch-all for strategic investments, particularly in technology companies. Home building made $7.3 billion in revenue, then $277 million for financial services, with smaller amounts from multifamily and Lennar Other, a segment which made $7 million. Most of their profits came from home building, with $809 million in operating income. Financial services also contributed with $143 million loss due to some investment write-downs. Lennar made some big moves recently. They spun off Millrose Properties, and it seems like it's part of a plan to go land light. And they also bought Rausch Coleman Homes, expanding their reach in the south. Like any business, Lennar faces risks. One big one is the housing market itself, which could slow down if people stop buying homes. They are also worried about rising costs for materials and labor, and any new tariffs that could make things even more expensive. They also have to deal with the usual legal issues that come with building a lot of homes, such as claims about construction quality, etc. They returned cash to shareholders through stock repurchases and dividends. Stockholders' equity decreased a lot this quarter, a $5 billion drop. This was primarily driven by two things: their spin-off of Millrose Properties, which involved giving away a lot of assets, and they bought back a significant amount of stock. This is where they estimate the value of some of their assets and debts based on what they think they are actually worth on the market. Lennar uses variable interest entities, which are kind of like partnerships to develop land and build communities. This helps Lennar share the risk and keep debt off its balance sheet. It means some of the assets and debts are technically not on Lennar's books directly, but they still have a stake in them. As usual, it includes a warning that anything could happen and that these forward-looking statements could be wrong. Looking at the raw numbers, it seems to me that average sales price of homes delivered decreased a little this quarter, meaning that perhaps the hot housing market is slowing down. That, coupled with sales incentives that they are offering jumping about 20%, means they are trying to move product out the door. Also, net cash used in financing activities jumping so high is alarming unless you read that a lot of it went to repurchasing their shares, which, depending on how you look at it, is either a bold move or a Hail Mary, especially when all their other metrics didn't look so stellar. Their assets are way higher than their liabilities, but stockholders' equity got hit pretty hard to give you those earnings per share. Overall, this quarter is not that impressive. They are still profitable, but not as profitable as previously. While still as leveraged, we will see if they manage to turn it around. So there you have it, a deep dive into Lennar's latest financial report. Based on this information, it seems Lennar is making a big bet on the future with their current landlight strategy. Remember, the housing market is notoriously unpredictable, and these are just snapshots in time. Thanks for watching. Don't forget to hit that like button, leave a comment with your thoughts, and subscribe for more corporate deep dives.